Hello, everyone, and thank you for joining us today. My name is Kelsey Lefebvre. Welcome to the 2025 Forest Products Outlook webinar. Before we get started, I'd like to offer a few technology tips to keep in mind while you're viewing today's webinar. First, all attendees are muted throughout the presentation. Once in a while, it's a good idea to tap your mouse so that your screen does not go to sleep during the presentation. There will be a time for questions and answers at the end of the presentation. Questions can be text chatted in at any point during the presentation. To send in your question, click on the question mark box on the right side of your screen to expand a question box where you can then type it in. A recording of today's webinar and the presentation materials will be available at farmcrediteast.com as well as on our YouTube channel. And now a quick disclaimer, this information is presented in good faith and is not intended for investment, tax, or legal advice. And then quickly today, we do have continuing education credits that have been approved for the Society of American Foresters and Connecticut CEU credits. If you need proof of attendance of this webinar, please email Chris Lawton for more information. His email is displayed here, but it's also chris.lawton@farmcrediteast.com. Okay, and today we have Paul Jannke of Forest Economic Advisors presenting an outlook on the forest products industry. Paul's main area of expertise is North American lumber markets, having spent over 25 years analyzing lumber markets. I will now hand it on over to Paul.
Great. Thanks, Kelsey. Hopefully I can get my screen. There it is. So thank you very much for the introduction, and thank you to the folks who are on the call. I appreciate you taking the time to listen in today. I am going to delay a little bit here in the hopes that you'll be able to see my screen. So yeah, I have about an hour. I'd like to try to go faster than that if I could, to leave some time for questions if you have any. But I do have 54 slides, so I have a lot of material to get through. So what I'm going to be talking about today is generally some of the things that are concerning for us in the economy, leading down to where we see housing starts. Certainly the February release of housing starts came out. It was quite strong, and I think most people were probably pretty happy to see that. But big seasonal adjustment factors in February, and if we actually look at the average of the past 4 months, it came in right around 1.4 million units, which is actually our forecast for the year. So we're basically looking at flat housing starts relative to what we've seen over the past 4 months or so for the year. So why is that? Well, to start, this is probably the main factor influencing our forecast and influencing our pessimism over the next year or two. I will have some slides talking about the demographics, demographic tailwinds and pent-up demand, and those are definitely the positive side of this. If you think about the fact that we had interest rates go from 3.5 to 7.5, and actually for a short period almost 8%, and housing starts dropped from 1.6 to 1.36 million units. I mean, that's hardly any drop at all. And 1.36 is that's not a recession low. And you see a 4% plus, 4% plus increase in interest rates, and housing starts don't really budge much. I mean, they come off a little bit, but not what we would typically expect after seeing such a sharp rise in interest rates. So those are the positives of that, those strong demographics. But the negatives are that it's very it's become unaffordable to purchase a home. So what this just shows you is the amount of money that a person would have to spend to buy a median home, given current interest rates, insurance levels, taxes, that sort of thing. And you can see that this has increased more than 50% since early 2022. And it's really brought home ownership out of the realm of affordability for a lot of families. And I think this graph really shows that very, very well. So What this shows is the median income in red. You can see that's about $80,000 a year. And then the green line shows you the qualified income that you would need in order to make your mortgage payment no more than 30% of your annual income. So you would need, and if you look at this through 2010 through 2021, most folks, the median household could, could keep their mortgage payments down around that 30% level of their overall income. But starting in the beginning part of 2022, it has become very difficult for a median income family to be able to afford a home. So this jump, that massive jump in the qualified income or the income needed to be able to keep your, it's not the income needed to be able to afford a home, but it's to keep your mortgage payment below 30% of your annual income. So, and that's a good target that folks are trying to reach. So it's become significantly less affordable to purchase a home. So why is that? I don't know if we have any home builders on the call. Sorry if we do, but if you're a home builder, if you're part of NAHB, you're probably going to say it's because of lumber prices. Lumber prices have gone up so much that we can't afford to buy homes. Folks can't afford to buy homes, but the reality is actually something different. Let's see if I can get this thing to actually move. So what this graph here shows you is it's just a scatter plot of home prices versus lumber prices, and you can see that there is no correlation at all between lumber prices and home prices. It's just a big blob right in the middle. So so there's not. So anyhow, so we don't think that lumber prices are really a driving factor in home prices or panel prices for that matter. And just an aside as well, because we've been hearing a lot about the tariffs that are coming on and how that's going to make it unaffordable for folks to purchase homes. So we just did some calculations here, and if we passed on the full 25% tariffs to the homeowners, which is unlikely to happen, the mills will the mills will have to absorb some of that 25% tariff. The Canadian mills will absorb some of it in terms of lower profitability, and on the U.S. side, you won't see U.S. lumber prices going up, but U.S. produced lumber prices going up by the full 25% because they're going to be buying market share from the Canadian producers. So we won't see a full 25% increase in lumber and panel prices. But if we assume that they did increase by that full 25%, that would add about $23 to a typical mortgage payment for a new home. And just to put this into perspective, that's less than a 0.09% increase, so less than 10 basis point increase in interest rates. In other words, if you have a 10 basis point increase in interest rates, you'll see your monthly payment go up by $25. Whereas if we have a 25% tariff that's fully passed through to the consumer, it's only $23. So I just thought that was a pretty interesting little tidbit. So yeah, so what is it that has been causing home prices to rise so rapidly? I'm sorry, affordability to deteriorate so rapidly is what I should have said. Well, one of the issues is insurance premiums. This graph just shows you insurance premiums over the past decade. And you can see that they were pretty flat around $1,600 for most of the end of the last decade. But then towards the beginning of this decade, they've shot up and they've gone from $1,600 up to almost $2,000 per year on average. And these are only going to increase. The fires in LA, the fires out west in California, the hurricanes that came through Florida, and all the rebuilding that's going on there, the hurricane that went through North Carolina, those are all going to cause these insurance premiums to continue to rise. So this is certainly affecting affordability negatively. Another component is the fact that home prices continue to remain extremely elevated despite the rapid rise in interest rates, which is actually fairly amazing. So you can see that we're at record levels of home prices, well above where we were back in, this is all inflation adjusted, so back in the early 2000s, and we're back above where we were in 2000, right after COVID in 2022-23 timeframe. So we see quite high home prices, which is certainly negatively impacting affordability. And this is just, I'm going to keep on coming back to this, but we had a massive rise in interest rates, which I'm about to show you. And despite that massive rise in interest rates, we haven't seen home prices come off, and we barely saw housing starts drop at all. So these are both indicators that of those the tremendous amount of pent-up demand and the strong demographic tailwinds that are bolstering our housing market. So there's a lot of negative in the beginning of this presentation about the overall economy and affordability. We don't think we're going to see housing starts growing much at all this year. So there's a lot of negativity there, but on the other hand, there is a lot of positive to take out of this, in that even though we have a lot of economic headwinds, the demographic tailwinds are preventing a real recession in housing, which we would expect. So why would we expect that? Because of the rapid rise in interest rates, which I'm showing you right here, but also that massive decline in affordability, which I've been talking about. So this ties back into that massive decline in affordability, and that what has caused that? Well, part of it was the rising insurance premiums. Part of it is the rising home prices. Most of it has been caused by this very, very rapid increase in interest rates. And you can see each of these graphs just shows you the Fed's a period in which they were raising interest rates in order to slow the overall economy, going back to the 1980s. And you can see that this last one in 2022 was the fastest and the steepest rise in interest rates that we've seen in half a century. So given that, it's dramatically impacted affordability to the negative, which is why it's difficult to see a big increase in housing starts unless we have an improvement in affordability. And the way you get an improvement in affordability is through lower mortgage rates, lower home prices, lower insurance premiums. So home prices have been very sticky. They haven't come off much. Historically, they don't tend to fall very much, but we could see some relief there. Insurance premiums, we're certainly not going to see any relief there, because if anything, we're going to be seeing insurance premiums moving in the other direction. And that really leaves mortgage rates. And really the hope for declining mortgage rates, or a large decline in mortgage rates, has somewhat been dashed recently with the uptick in inflationary pressures that we're starting to see because of tariff talk. So there's a lot of things that play here in the U.S. economy, and I don't want to focus too much on that. Happy to address that in any questions that we have. But certainly the U.S. economy is going to slow, and I'll have some slides on that. And that is going to allow for decreased inflationary pressure. It is going to allow for the Fed to actually start to lower interest rates, but it's not really why we want them to be low. We don't want them to be lowering interest rates because the economy is slipping down towards negative economic growth. We want them to be lowering interest rates because there's no inflationary pressures and the economy is still growing robustly. Unfortunately, they stopped lowering the interest rates because we've seen a reversal in the downtrend in inflation. So what this graph shows is this is just the average of the last 3 months over the previous 3 months. And the reason why we do that is you don't want to do a month over month average because there's way too much volatility in that. So by doing 3 months over 3 months, you're smoothing out some of the volatility that we see month to month. On top of that, if you just do quarter over quarter, you're going to be 3 months behind. So this gives us a more up-to-date picture, but takes some of that volatility out. And what we see is that by both measures, either the PCE, the personal consumption expenditures, or the CPI, either way you look at this, we still see inflation above the Fed's target of 2%. So this is negative from the perspective that the Fed is unlikely to continue to lower rates. I mean, this is our forecast that we've had for months now, and you can see that we're entering a period where we think the Fed is going to pause. I don't know if you can see my cursor. Here it is, where we do think the Fed is going to pause before they start lowering rates again towards the middle to end of this year. And we only have 2 quarter basis point declines or reductions in the Fed funds rate this year, whereas last December, November, we had 5 to 6. So the uptick that we're seeing currently in inflationary pressures has caused the Fed to be more cautious in their lowering of interest rates, and adding 25% tariff onto imported goods is inflationary, so that's another reason for the Fed to be concerned and for them to hold interest rates flatter longer. There's not really a lot of hope for improving affordability through a large decline in interest rates, not at least in 2025. As we get into 2026, with the economy slowing some this year, with the economy adjusting to any potential tariffs, which, by the way, we don't actually forecast the tariffs to be maintained for an extended period of time. We do think that they are a negotiating tool to try to negotiate more favorable trade agreements with, in particular, Canada and Mexico. And so we do see, we don't see the inflationary pressures lasting for an extended period from those higher rates. So anyhow, all right. So let's go to the overall economy. So interest rates unlikely to come off that much. How about income growth? Well, it's unlikely that we are going to see strong income growth, at least early this year. So this is the Fed's GDP now. What that is they take they have a model built, and they take all of the economic indicators that are out there that go into their model. And every time a new indicator is released, they plug it into their model, and it spits out a new estimate for what GDP is going to be for the current quarter. So in this case, it's for Q1. And then this blue line is just the consensus of all the analysts, or the top 10 analysts that are out there. So what we see is the analysts are thinking that growth is going to slow a little bit, but growth is going to be negative in the first quarter. And especially when we're this far into the quarter, into the end of March, the GDP Now indicator is pretty accurate at predicting what we're going to see for Q1. So we're likely to see negative growth in Q1, so a decline in overall economic activity. So then begs the question: is this a systemic issue that's going to play out through the course of 2025, or are there temporary issues which are causing this? And the answer to that, in our mind, is that is somewhat both. But for the real negative growth, for the decline in actual activity, that's really being caused by temporary factors. So 2 temporary factors in particular. One is inventory change, and inventory drawdown, and 2 is a massive increase in imports, which makes a lot of sense, right? We're threatening to impose and imposing 25% tariffs on a lot of our trading partners, and so they're shipping as much as they can into the U.S. market to try to get ahead of these tariffs. And so what we're seeing when that happens is that an import comes in as negative on GDP growth. So your imports your GDP growth is consumption plus investment plus government spending plus net exports, and net exports are exports minus imports. So if imports go up, net exports go down. That's mostly what's driving this down. So what we think is going to happen in Q2 is that we're going to get a bounce back. So then the question comes, okay, we get a bounce back. How sharp is that bounce back? And the answer is it's probably not going to be extremely sharp. So if you look at the index of leading economic indicators, we did have a pause back in December, but that's now resumed its downward trend. So these are a number of different indicators that are forward-looking. So if this is trending down, you can see historically every time the leading indicators have fallen, we've gotten into a recession. So these gray bars mark recessions. You can see after the leading indicators decline, we end up with a recession. Strangely enough, the leading indicators declined pre-COVID too, and it's interesting that they were able to pick that up. So this is pretty much the longest, sharpest decline in the leading indicators outside of the Great Recession, and we haven't seen a recession come about yet. which has been amazing. Part of the reason was the Fed engineering that soft landing. Part of the reason was a tremendous amount of government spending that was going on. And then another portion of that was the fact that we had a tremendous amount of excess savings. Why do we have excess savings? Well, we had a lot of income during COVID. The government gave us a lot, several $1 trillion. They just handed out to us, and folks didn't have anything to spend it on. So we saved it. And then slowly after COVID, we started spending this down, and that helped to bolster the U.S. economy. But the position that we've been in since, basically this time last year is our excess savings have actually all dried up, and now we're actually tapping into our current, what we would normally be saving, and drawing this down a little bit. So on a forward-looking basis, it's unlikely that we're going to continue to tap into our savings in order to maintain our spending. So that's certainly a negative for the overall economy. So, and then if we look at this in terms of a recession, an actual recession within the next year, mixed. If you would ask me on a prior to 2 years ago, I would say a reading of 27% chance of a recession was a pretty high likelihood of actually having a recession. But the reality is that it's quite a bit lower than the recession risks that we had seen for most of the previous year and a half to 2 years. So we were up around the 60 to 70% chance of having a recession. We're now down at 27%. So unfortunately, it had dropped to 23% in January. February, it bounced back up to 27%. That has to do with the slowing economic activity and the fact that the Fed has also stabilized interest rates at this point. And we've seen actually interest rates start to move back in the other direction. So I guess this is a mixed bag. I would say that the situation is significantly better than it was last year at this time in terms of the probability of a recession. But on the other hand, it's still, the probability of a recession still remains decently high. So what does this mean for housing starts? Well, we had 137 last year for housing starts. We're looking for a slight growth this year to 1.4 million units. So basically flat housing starts for the year. We just don't see real reason to be optimistic about improvements in affordability. And without real improvements in affordability, it's going to be difficult for housing starts to move much above sort of 135 to 145 level that we've been bouncing around at for the past year or so. So that's the bad news. I guess there's two pieces of good news in here. One, single family starts have been rising and they will continue to rise, and I'll get into more of that later. And two, we do see, if we're looking out towards 26, we do see more of a bounce back here. And this will occur because in our minds, we do see some strength, underlying fundamental strength in the US economy. We do see some stability coming as the tariff picture becomes a little bit more clear. We have seen a massive amount of reshoring of US industry that occurred, started occurring back in 2020, 2021. And a lot of these buildings that have been built, I can address this in questions if you want, and actually show you some slides on just how much building occurred over the past 4 years. Those, that massive amount of reshoring of manufacturing is going to start to come online. We'll start to see job growth increase, and we'll start to see incomes increase because of that. We do see mortgage rates continuing to trend lower. So all these things should bolster housing in 2026 and cause housing to bounce back decently robustly. And then the final piece is what I talked about before with the massive amount of pent-up demand and the strong demographic tailwinds. Before I get into that though, just real quick, we do see continued strength more in the single family than the multifamily sector. And that can really be seen here in this graph of housing multifamily starts versus multifamily completions. And you can see this big jump up that we saw in multifamily starts that occurred in the 21 to 23 timeframe. But we weren't completing any of these homes. We were just starting them. It takes quite a bit longer to complete a multifamily home than a single family home. So all of these starts have been coming online over the past year. And because of that, we just simply don't need as many starts anymore. So we've seen a massive drop in the multifamily starts. Luckily, a lot of this starts over completions period is now flipped over to completions over starts. So as we go forward into the 26-27 period, we'll start to see a little bit more strength coming from the multifamily sector. So why do we have this strong bounce back? And if we went out to 27, 28 timeframe, why would we expect to see even more strength in the housing markets? Well, part of it is that while the U.S. economy has a lot of headwinds right now, and we're facing a lot of difficulty, we do have a lot of fundamental strength. I had mentioned the massive amount of reshoring of U.S. manufacturing that started taking place about 4 years ago. A lot of that is going to come online. In addition, our balance sheets are in quite good shape. This is the amount of our income, the percentage of our income that we need to spend on just servicing our debt. So if we're spending it on servicing our debt, we can't be spending it on consuming goods. And if we can't spend it on consuming goods, that's just things that we're not buying. So it's a lack of strength in the U.S. economy. And aside from the COVID massive declines that we saw in the percentage of our income that we're spending on debt, and these were just simply related to the 2 government transfer payments where the government handed out checks passing out $1 trillion each time to U.S. consumers. So that dramatically increased our incomes for short periods of time. So it lowered our debt payments as a percentage of income. So if we take those massive declines out, we're really, yes, we've seen a decline in the amount, I guess I should say an increase in the percentage of our incomes that are going towards servicing debt. But on a trend level, we're still well below sort of any time in history besides these past few years. And most of this increase is not coming from us taking on more debt. It's come from an increase in interest rates. So part of this is strength in the consumer position, and part of it is just the massive amount of pent-up demand and the strong demographic tailwinds. So what is the massive amount of pent-up demand that I'm talking about? Well, here's our underlying demand. On average, these are how many housing starts we need to build to house our growing population. And to take care of removals that come through fires and hurricanes and tornadoes and that sort of thing, natural disasters. And you can see historically our actual housing starts, which is red, has fluctuated around the underlying demand, the average levels, until the mid-1990s, at which point housing starts were well above underlying demand. So we spent up a lot of future demand. We built way more homes than we needed to house our population. We had that stimulated the Great Recession. We saw a collapse in housing markets, and then for more than a decade, we've been producing well below, and we're actually now pretty much at 2 decades, almost the entire time producing below what we need to produce to house our growing population. So what's happened? Folks have doubled up. Young folks are living at home longer. They're living with more roommates. We have parents moving in with their adult children. We have increase in multi-generational living, and then we also have unrelated households moving in together because folks simply can't afford to live on their own, and this all comes back to affordability. So once we see affordability start to improve, this massive amount of pent-up demand will be released, and we saw this here during COVID. Was that when we had an improvement, well, not so much an improvement in affordability, but we had we had a release of some of this pent-up demand post-COVID, and we saw a big increase in housing starts. In addition to that strong pent-up demand, we have really good demographic tailwinds. So what this graph shows is our population by age bracket. We've highlighted the 30s, well, it's historically the late 20s and early 30s, but because of the increase of younger folks living at home, this is now shifting towards the 30 timeframe. This is your prime home buying years right in here. And you can see that we have a peak of our population is in these prime home buying years. So those are really strong demographic tailwinds. I also wanted to just point this out. I threw this purple line in here because a lot of folks, there is some talk about how this decade's going to be okay in terms of demographic demand for housing, but next decade, watch out, things are going to be really bad. But the reality is we're going to continue to have, this is 2035, so the 2030 to 35 period, we're going to continue to have this strong strong demographics. So that's if they were looking at the red bars where these folks are currently. These sort of 25-year-olds now are going to be moving in through over the 30 to 35 period. They're going to be moving through this prime home buying years. So I think we have more than a solid decade left of strong demographic tailwinds. So, so that's it. That's our housing starts forecast, which is weak starts, relatively weak starts relative to what we'd like to see, but actually strong relative to the lack of affordability that's out there, with that strength being provided by the tremendous amount of pent-up demand and the strong demographic tailwinds. So now I want to turn our attention to the market that's larger than the new home construction market for demand for solid wood products, and that is the residential improvement market. You can see that residential improvements, the blue line, has been very strong lately. It's been well above trend. We do think it's going to come off some, but we think it's going to remain above trend. Why is that? Well, for one thing, we have an old housing stock. Well, I do these presentations sometimes in Europe, and they kind of laugh at me and say 44 years isn't old. But if we look at it relative to where we were 10 years ago, our homes are 7 years older on average than they were 10 years ago. And if we go back, 20 years ago, they're 14 years older than that. So 13 years older than that. So our homes are getting older, and they're quite a bit smaller. If we look at the average home size, even taking into account all of the improvements and additions and alterations that have taken place, our average existing home is still more than 20% smaller than a new home that's built today. So, if you're buying an existing home or you're living in an existing home, there's a good chance that you're going to want to make it a little bit larger to conform to more of the standards that we're seeing in the new homes that are getting built. So, yeah. So historically, what we've seen is that that residential improvements tend to take place after a home is purchased. And so one could look at this and look at just the really low levels of existing home sales, which is what this graph shows. And in fact, our existing home sales are in line with Great Recession levels, right? Actually lower than Great Recession levels. So there's very, very few existing homes being sold. So given the historical connection between selling a home, your existing home, and then folks coming in and fixing it up, one would think that this should be really bad news for R&R expenditures. But exactly the opposite has been taking place. We've actually had very strong R&R expenditures despite the lack of home sales. So what's going on? What's happening is that because of the rapid rise in interest rates, folks are being stuck in what we would call rate lock, where their interest rate, in order for them to buy a new home, they're going to have to pay a significantly higher mortgage rate. And so they're choosing not to do that. So they're choosing to fix up rather than move up. And the perfect example of this is the young couple who bought a home in 2020, got a rate that was 3.5%, a mortgage rate that was 3.5%. They bought a 2-bedroom home with the plan of having a family and moving up to a 3 or a 4-bedroom home once they started their family. Well, mortgage rates are now significantly higher, and so instead of selling their current home and moving up to that 3 or 4-bedroom home, they are fixing up their 2-bedroom home. They're improving it and adding on to it and making it a 3 or a 4-bedroom home. And to put some numbers behind this rate lock, what this graph here shows is the percentage of mortgages that are all these various levels below our current mortgage rates. So in other words, if we're looking at this blue line right here, and I'm just going to round all these, you guys can look at the actual numbers yourself. But so this blue line right here is about 25% of mortgages, actually more than 25% of mortgages are more than 3.75% below current mortgage rates. So we'll just say almost 4% below current mortgage rates. So if current mortgage rates are 6.75%, a quarter of mortgages are 2.75%, or roughly 2.75%, or lower. So if you have to go, and then let's just take rates that are at least roughly 3% below current rates, that's 60% of mortgages are at least 2.75% below current mortgage rates. So for those folks, if they're going to move up and sell their existing home and buy a bigger home, they're going to be paying almost 3% more. So that, just like quickly doing the math, that's 260 times 3 is $840 more in a mortgage payment on a median priced home. Yeah, it's significantly more on a median. If you're talking three full percentage point increase is about $860 more on a median price home. So it's significantly more that these folks are going to have to pay. So they're choosing to fix up rather than move up. So that's a reason why R&R expenditures should stay strong. If you're going to fix up your home, you need to have the money to do it. And luckily, home equity is very, very high, so people can tap into that home equity. Why can they tap into home equity but not be willing to pay for a mortgage? Because the home equity is only used on the portion of the house that you're fixing up. You don't use it for the rest of the house. Whereas if you're moving up, you have to take out a mortgage on your entire home. So lots of home equity out there to tap into. It's all good and well if you have equity to tap into, but for a long time, it was really hard to get any contractors to do any work on your home. That situation has changed pretty dramatically. So we've seen fewer folks going off to college, more folks entering the trades. And so we're just looking at the number of specialty trade contractors here. And it's back up to roughly where it was in 2006 for its previous peak. So that's good news that the folks are there. The contractors are moving back. We're getting more and more contractors to be able to do this sort of work. I'm going to skip that slide. So what does that all mean? I mean, I can tell you what it is. It's the percentage of folks that are working from home, and that should, when folks are working from home, they need more space, so that should help to bolster R&R activity too. So what does this all mean for lumber consumption? Well, not a lot of increase in housing starts, but that shift towards more single family is going to be good for overall consumption. So in 2025, we're looking for consumption to increase about 1%. So 700 to 800 million board feet increase. So really not much change at all in lumber consumption this year. And then about 4% increase in 26 as we see a greater growth in both housing starts, new residential construction, and R&R activity. Exports, we're really not looking for much in the way of improvement in exports. We have a little bit of growth in exports. Most of that's going to come, this is offshore. Most of that's going to come from Canada as Canada looks for alternatives to send their lumber to outside of the US market. Not a lot of growth in the US, but still some growth. And the reason why there'll be some growth is because if we look across North America as to where there's excess timber in order to be able to produce lumber, it's southern pine, right? Southern pine is the area that has it has a tremendous amount of excess timber. The other regions, for the most part, are tight on timber supply. So that's doing two things. It's increasing the supply of lumber that they can sell into markets, and it's lowering the price. And so this blue line shows the relative price of southern yellow pine to SPF, and you can see that ratio, that's the blue over here, southern yellow pine used to sell for a premium, but now it's selling for quite a large discount to SPF. And with that, we've seen the exports explode. So that will continue to be a factor going forward. But we also still do think that you will have an increase in Canadian offshore exports as Canada searches for alternative markets. And there's already some story in the news about Canada sending a trade mission, BC sending a trade mission to Taiwan and South Korea to look at, Taiwan and Japan to look at increasing their exports there. And I know of a number of Eastern Canadian companies that are looking to Europe and Middle East and North Africa to ship their wood as well. From an import perspective, this is offshore imports. We do think that's going to offshore imports are going to continue to trend lower in 2025. I will say that this forecast did not assume a 25% tariff on European lumber shipments into the US. The vast majority of these imports into the US these are offshore imports. The vast majority of those are European. If we do assume a 25% tariff on the European shipments to the US, then these numbers will be lower. The reason why we have them staying relatively elevated is that simply the European markets are quite weak right now too, so they need an outlet for their wood. So these next 4 slides, I'm just going to flip through really quickly. You'll have them. I have a QR code at the end of this that you can link to, and it'll just, all it does is it creates an email that you can send to me, and I'll send you the presentation if you want to see it. So this is really here for you, but it's just a list of all the indefinite, temporary, and permanent closures. So one of the factors that's been at play in the markets over the past 6 months is we've seen a tremendous amount of closures. If we're looking at permanent or indefinite closures, things where we don't know if they're going to come back at all, it's about 3.7 billion board feet, with another 1.5 billion board feet of temporary closures, for a total of 5.2 billion board feet of closures. So that's a dynamic that's at play in the marketplace today, in that we have about 5 billion board feet of closures that are taking capacity out of the market. 3.7 of that being essentially permanent, with 1.5 billion of that being temporary. So it's a significant amount of productive capacity that's been taken out of the market, trying to balance that demand supply balance. If we look at where it's coming from, you know, from the permanent perspective, it's pretty evenly split between BC and the US South at right around 40%. The West has about 20% of those closures. And then not a lot of closures, no permanent closures in Eastern Canada, and then a little bit of permanent closures in the Northeast and North Central region. If we're looking at temporary, you get a little bit more. About a quarter of the closures are coming from Eastern Canada, and a little bit less from the US South. So this will be at play in the market. It's part of the reason why we're seeing prices go up. Another one is that inventories have fallen. So this is the month supply of inventory. The bottom of the blue area is the 25-year low, and the top of the blue area is the 25-year high. This red line is where we're at today. I did throw the yellow line in here to show the pre-COVID lows, because, you know, this is really what a low would be outside of COVID. COVID were special circumstances. And that puts the red line, which is where we're currently at, a little closer to our historic lows than if we were looking at the bottom here. And then this is just where we were last year. So you can see we're in better position from an inventory perspective than we were last year, but our inventories are on the rise right now. In addition, prices have gone up quite significantly. And so prices are well above costs pretty much across every region. So this graph needs a little explaining. The bars are the cash costs to operate. The yellow portion of the bar here are the duties, and the blue portion are the tariffs, if we have a tariff on there. And then this is the average sale. These dots are the average sales price to cash cost ratio. And this blue one does include only the duty. The green one the blue here is the duty and the tariff, and then the green is just the duty. So there isn't currently a tariff on Canadian goods. So this is where we're at right now. On April 2nd, we're likely to drop down to these blue dots. So what does this all mean? Well, if we look at this combination of, we do have a decent amount of inventory that's out there. It's been building. On top of that, mills are quite profitable right now, pretty much across the board. So in the near term, we do think that prices are going to be coming off. If there is a tariff that's slapped on, you know, a lot of folks are going to think that that's going to cause prices to move back up again. I think that's going to cause prices to stabilize in April, as dealers who have been buying wood ahead of this duty imposition are going to move to the sidelines, and mills are not going to be willing to drop prices because they have that new 25% tariff. And then our opinion is that the tariff will be removed within 6 weeks. if not more. We are less and less confident so this has been our stance for this entire year. We thought that tariffs would be imposed, but then they would be taken off because we didn't think it made sense. We thought it was bad for both economies, so there are incentives for both economies, for the leaders of both economies to negotiate a solution to this. So far we've been proven right, but every time we get a new tariff put on, the likelihood of that staying on for a longer period of time is increasing. Because at some point you need to follow through and with your threats and keep them going. So in any case, we do have the tariffs coming off in mid-May period, in which case we'll see further downward pressure on prices. We do see prices bouncing back up again in the July-August timeframe. The duties are going to jump up. In fact, I'll just jump right there. Here's your duty rates. And you can see that this is our current rates. This is the final determination from AR-15. And you can see our current rates are 14.4%. And then this was actually our estimate, but I think our estimates came in at really close to being right, which was that we were assuming the combined rates would be about 27%. So that was actually 27% is almost certainly where we're going to be. The preliminary estimate for the anti-dumping was 20%, so we'll see duty rates of about 20%. On top of that, you're likely to see an increase in the countervail, which is currently 6.7%. So this will probably be closer to 30%. So that's where we're moving with the duties, and so should help to bolster prices in the July-August timeframe. So here we are with the duties, 25%. So once the AR6, we get the final determination, which will be August for the anti-dumping and November for the CVD, we'll be in the 52 to 57% range. So what are these higher tariffs and duties? What are they going to do to the overall markets? Well, it's going to drive prices higher. Sorry, Southern Pine West Side. If I did East Side prices here, you'd see this is about an 11% increase. You'd see about a 16% increase in East Side prices. This assumes duties get taken off in March of next year. We had to make assumptions, so that's kind of what we did, 1 year of duties. We will see lower North American consumption and lower North American production as Canada loses share of the market. So again, assuming no tariffs on offshore imports, we will see higher offshore imports and a pretty sharp drop in Canadian shipments to the US. So yeah, let's go down to so then on the export side, I'm happy to address any of those things if you want as well, which is just sort of what the situation is in Europe right now. In terms of offshore exports, we do see US offshore exports declining, and we do see Canadian offshore exports increasing, but we don't really see a large increase in Canadian offshore exports. And the reason is because the main destination for those exports is China. And if we look at the Chinese real estate market, it's in really, really rough shape. So this shows Chinese real estate transactions as a percent of GDP. And you can see that that's historically been in the 15 to 20% range. If you go over most of the past decade, that has dropped tremendously down below 10%. And I could say we have an office in China, and I go there every year. And this is the first year that I've had pretty much everyone I talked about just how pessimistic they were about the overall economy in China. It's something that we've actually been pointing out for probably close to a decade, that their demographics were bad, that their over-reliance on exports was bad, and that we were preparing for a pretty major decline in Chinese economic activity and Chinese lumber consumption as well. So I did have a few slides in here that I'm not sure how much you folks want to talk about this, but I'll just kind of go through these quickly and try to save some time for questions here. But the main point in this slide is it shows us costs across regions, and you can see that there's really two tiers of costs. There's southern and eastern costs down here, and then there's western costs over here. So BC and then the US Inland West and US Coast. And you can see there are two different tiers of costs. And this is all related to timber supply. I think you all are aware of what's going on in British Columbia in terms of the declines in the fiber supply there. You know what's happened with the mountain pine beetle, but there are also wildfires, spruce bark beetle, mountain caribou habitat, forest tenure transfer, old growth of all those different things reducing their AACs. In the US West Coast, we've seen about a 10% reduction in their sustainable yield. This has come through private forest accord and revisions to the Forest Practices Code. And then also losses from the Labor Day fires back in 2020. Happy to address supply that could come on from the federal in terms of questions, but I won't do it just here. There's some opportunity to harvest in the east and lots of opportunity to harvest down south. So those things are the reasons why we see those two separate tiers for the cost structure, with the west with its limited fiber supply being higher cost than the south and the east. So with that, I just sort of to sum it up, we're probably at the bottom of our current, so last year was probably the bottom of our current cycle, but any sort of growth that we see is going to be slow this year because of the continued lack of affordability. There's not going to be a lot of hope in export markets because our main export markets remain weak, and there's a tremendous amount of competition, with Europe trying to get into those markets as well. We do see imports falling longer run, especially because of supply constraints, which I didn't talk too much about, but their supply constraints longer run is that they had a spruce bark beetle epidemic, which is very similar to the mountain pine epidemic. And then there's also a number of changes that they're implementing in Europe to try to mitigate climate change. And those factors are going to reduce the supply of wood that's available, and we're seeing that in rising wood costs right now. So long run, imports, we're not looking for imports to go back to where they were from Europe. I think in the beginning, I asked the question, were tariffs and duties enough to bolster or to offset stagnant demand? And the answer to that is yes. We will see the tariffs and rising duties as holding up prices this year higher than they would have been last year. So with that, this is a QR code. If you actually hold your camera up to it, you will be it creates an email that you can send to me if you want to get a copy of the presentation. You can copy down my contact information if you want, but using that QR code will get you we'll set up an email directly to me that says, hey, send me your presentation. So happy to address any questions if you folks, if you have any.
Yeah, thanks for that presentation. I think we have a couple questions. So you covered housing starts and demand. Is there anything specific to the Northeast? Any insights for our area around all of that?
Yeah, so a lot of the general comments that I've made apply to the Northeast, which is that there's a lack of affordability. We have an additional issue in the Northeast, which is a tremendous amount of regulation, which makes it difficult to build new homes. It's a problem that we're starting to see get resolved in Massachusetts. They're starting to try to ease up some of the regulations that we can build more homes, but it's definitely a problem here, and it's a NIMBY problem. Folks don't want to have homes built in. If you're a homeowner, so you're a taxpayer and a voter, you don't want to build more homes because building more homes increases your tax base. It also increases the number, generally tends to increase the number of children in your district, which tends to increase your taxes more than it increases your tax base. On top of that, if you increase supply, that decreases the demand supply balance, and so that lowers the potential price for your home. So you get a lot of pushback on building new homes, and a lot of folks looking to looking for regulations to prevent home building. On top of that, I would say that generally speaking, we tend to be a more liberal region of the country, so we have more environmental regulations preventing folks from building homes. And a final piece is that we do have generally speaking, our population is moving south and to a lesser extent southwest. And as that happens, there's less need to build homes. So the problems that are facing the country are exacerbated a little bit in the Northeast as well. Having said all that, just like every other region, we are dramatically underbuilt. So if we do have lower interest rates, then we will see housing starts bounce back in the Northeast in the same way they do in other regions.
Great, thanks. And then you also talked about right now we're seeing an increase in imports, which, is kind of affected by the tariffs. Do you have an idea of how long that will continue for?
Um, so how long? Yeah. So in terms of the tariffs, so we have our, as I said, we have our base case forecast, which is we assume that the tariffs are not going to be, they're not going to be a long-term sustained tariff. And we believe that the tariffs on Canada and Mexico are a negotiating tool, ostensibly to slow the shipments of fentanyl and immigrants coming across the border. I don't know exactly how much, what the sort of immigration or the numbers of illegal immigrants that are coming across the Canadian border into the U.S. And I don't know how much fentanyl is coming across the Canadian border into the U.S. It's pretty well documented what's happening through Mexico. But our sense is that it's probably not really an issue for Canada, but certainly it's a national. If it becomes a national security issue, then the president has the power to unilaterally impose these tariffs for national security reasons. And so we think that it's more likely that that's not the end goal, is to, while it's certainly to the extent that there is any fentanyl or illegal immigration coming from Canada, it certainly is part of the goal of the current administration to tamp down on that. But our assessment is that it's more likely that going after Canada and Mexico is an effort to renegotiate the USMCA, the US-Canada-Mexico trade agreement, which was going to be renegotiated in 26 anyhow. So it's just looking for an early renegotiation of that. So if that's actually what's the goal is here, then it's a tremendously damaging way to do that. If you're going to slap a 25% tariff on all shipments from Canada into the U.S., Canada, about 39% of the Canadian economy is sent to the U.S. market. So that's tremendously damaging to Canada. So Canada has a huge incentive to reach an agreement, to negotiate an agreement. And on the U.S. side, we've all seen how the stock market has reacted both times. The president has imposed these tariffs. It is inflationary. The Fed will have to keep interest rates higher longer. Interest rates are not going to react favorably. We are going to see negative economic growth in the first quarter, in part because of all the tariff uncertainty. So all of these, it's negative for the U.S. economy, which provides the U.S. with a lot of incentive to come to a deal as well. So all of these things indicate to us that we don't think that any sort of tariff on Canada is going to last more than 6 weeks. So interestingly, the longer it lasts, the more likely it is to become, semi-permanent and be there for an extended period. So if we're wrong on this and we see that if a tariff is reimposed on April 2nd and it's still in place on July 2nd, then the likelihood of its being in place in December has increased dramatically from where we're at today. I hope that helps. So if you want a very specific answer, I would say less than 6 weeks. And I would say probably even less than 2 weeks as well. Our forecast is less than 6.
So we have a few more questions that have come in. Does the increase in home improvement seem to be happening in the Northeast? And does that mean increases in hardwood lumber?
Yeah, so we do have an increase in the Northeast as well as in other regions around the country. And in fact, we're a little bit more tilted towards the Northeast because we have an older housing stock. Your housing stock in the South tends to be, it's significantly newer than the housing stock in the Northeast. And folks generally just tend to build new homes down there. Whereas in the Northeast, land is a much, buildable lots is a much bigger issue. They're much more expensive. So we're seeing more knockdowns and rebuilds. And when you have that, or just adding on, when you have that, we do have a tendency to use more hardwoods for our flooring up here. Less down south, there's more use of tile, and also we're more we use more hardwoods as well in our cabinetry up here than they do down south. There's more laminates being used down south. So from a consumption perspective, that should increase the usage of hardwoods in the Northeast as well.
Then we've got another tariff-related question. Do you think that the tariffs on China and other Far East entities will drive a return to the U.S. of furniture making?
No. And I mean, you have to put a tariff on everyone. You can't just put it on the problem with imposing a tariff on a single country is that country will just shift its production to somewhere else. So do we see tariffs? We've already seen it, right? Because we've already seen furniture production shift from China to Vietnam. So if we impose tariffs on China and Vietnam, then those folks are just going to move their production facilities to a country that doesn't have a tariff on it. That could be, Thailand, it could be Indonesia. If we impose it across the board, across all Asian countries, China has a good relationship with a bunch of different African countries, so they'll just shift the production there. So I think it's going to be difficult for the U.S. I think it's unlikely in my mind that we are going to see a major resurgence in U.S. furniture production. And the other piece on this is that it's not a strategic priority for us, whereas something like semiconductors, that is a strategic priority because there is a true military, not just that, a military and economic need for us to be producing semiconductors here in the U.S. So I think that there's going to be more of an emphasis on making sure that those are rebuilt here. But having said that, a tremendous amount of reshoring has already taken place, and in particular in the electronic side. I'm going to just, if I can, you can ask the next question, but I will. Once it pops up, I'll throw up the slide over here so you can see just how much reshoring has happened over the past couple of years. Here it is. So, Kelsey, can you see this?
Yes. Yep. It's.
Yeah, so
we
I'm
can
still
see your slides.
Yeah. So this is construction expenditures, and I mentioned it started a few years ago, and we've seen this massive increase, and here it is in real terms. And this is construction expenditures for computer, electronic, and electrical equipment. And so these facilities that they're building they're going to start producing the electronic goods. So this is a positive for our economy and a positive for the demand for lower grade and a positive for lower grade hardwood demand, because you're going to need pallets and packaging for shipping and dunnage for the trucks. So this is all good in the long run. So a lot of this reshoring has taken place on the tech side. But if we're looking at it in terms of overall manufacturing, it's actually quite a bit lower return to overall manufacturing. And again, it's because of the strategic importance placed on the semiconductors and the tech side.
Okay, we've got 3 more.
Okay.
Given our current underbuilt situation isn't new and spans back into the low interest rate pre-pandemic period, might there be some other factor causing historic housing starts to diverge from historic household format rates?
Yeah, so it's a really good question. And the answer is yes, in that we have some shift towards more multi-generational living, which has taken place anyhow. You have that's just, as the makeup of our population changes, we're seeing more of that. We're seeing more of an acceptance of children living with their parents significantly longer. But one of the things with the affordability so this affordability indicator, I gotta go all the way back, sorry. This affordability indicator, and it, you could say that things have remained decently affordable here, but this is all, this is median. So median payments on a median price single family home. So for a lot of folks, it doesn't take into account what's happening at those for those younger age groups who are not, there are a couple of things going on, but they're not, their incomes aren't growing very fast. There was a whole period, this entire people, I don't go back far enough here because their incomes started to grow right at the end of that sort of 2014-15 period, and coming into 2016, we started to see incomes were growing very rapidly, but it was all concentrated in the top, I would say in the top 1%, but it was actually all concentrated in like the top 0.1%. And it wasn't really until 2015 that we started to see a more equalizing of that and more of an income growth in the lower age bracket, in the lower income brackets. So what happens when you don't have when you don't have a lot of income growth in those lower income brackets, then we don't get the separation for those younger folks. On top of that, there's a change in there's a change in family dynamics, and kids are waiting much longer to have, well, young folks are waiting much longer to have kids these days. We're seeing them delaying marriage and delaying having kids. So that's something that's also at play here. I think there's a lot of questions as to whether is that, and it's something that we're going to find out, and I think we are kind of finding that out actually, and I'll explain in a second. But is that folks delaying having kids, where they used to have kids in their 20s, in their mid to late 20s, they're now having children later in their early to mid 30s. Was that a one-time change? Are we going to shift back? Are we going to stay where we're at? And our assessment is it's probably was a one-time change. We're probably not going to shift back. And then on top of that, but the good news on this is that it has a decrease. You have a tendency to decrease your demand for housing as you're delaying your starting up your family, because starting up your family is a major life event that causes folks to buy homes. So that's why I'm focusing on that. So if you were buying, if every person had a child at 25, and then that was the trigger that started you to buy a home, there'd be a decent demand for homes every time someone turned 25. But if you delayed that purchase till you were 35, then for 10 years you're going to have a period where, or you delayed that childbirth, and then therefore purchase till you're 35, you'd have a 10-year period where you have a decrease in demand. But then once these folks who would have originally had a child and bought a home at 25, once they hit 35, they have a child, they buy a home, the demand comes back again. So I know this is a simplified way of looking at it, but the argument that I would use that indicates that this is probably what's going on is the fact that we had a 4.5% increase in mortgage rates, and home prices didn't come off, and housing starts barely fell at all. So that just tells you that there's very, very strong underlying demand and demographic tailwinds to our housing market today. All right, I gotta shut up and let you ask another question. We're getting late. Sorry.
Are you still okay on time, Paul?
I'm totally fine. Yeah, as long as you
Okay.
folks are on, I can.
So we keep getting a few more. So any opinion on the new soft yellow pine futures contract expected to launch next week?
Yeah, my opinion on this is that it's not going to have that much of an impact on lumber markets for a number of reasons. One, let's just think back to the old contract, and let's go back to the old contract in not the past 5 years, but let's go back to the old contract 10, 15, 20 years ago. It wasn't heavily traded back then. So you could make the argument that it was because it was an SPF contract. Well, SPF, who owns most of these southern sawmills now? It's a bunch of old SPF, it's a bunch of Canadian SPF producers, Interfor, Canfor, West Fraser. Tolko owns a couple mills. So these are folks who weren't using the contract before when it was SPF. So why are they going to use those contracts today? Now that it's available in SYP. On top of that, so if aside from those sort of large players that are down there, you do also have a number of small players who are not, who probably don't have some of them might have the um, the willingness to take on the risk of playing the futures markets, but for a lot of them, they're going to be risk averse, and it's not going to be worth playing those markets. So I think what we're going to find is that maybe it's going to outstrip the current CME contract, but I don't think that it's going to make a major change to how folks operate in their markets.
Great. Any updates about plywood, OSB, and laminate markets? Anything
Yeah,
worth mentioning there?
yeah. So in terms of those markets, they haven't really been affected by the tariffs in the way that the lumber markets have. So those markets the OSB markets are more captive to the single family construction markets than lumber is. About 80% of the OSB that's produced goes to those single family markets. So the fact that we're going to have growth in single family markets this year, even though housing starts are flat, where you see a continued decline in multifamily and an increase in single family. So that should bolster demand for OSB. So we do expect to see OSB prices start to recover some over the next couple of months. So that should be beneficial. And then when housing starts continue to improve in 26, that'll be good for the OSB markets. On the plywood side, it's that increase in industrial activity that we do expect. And so, plywood is more reliant on the industrial markets than OSB is, and that we do expect to see improvement in industrial markets, and that is something that should bolster demand for plywood, so that should help out there. And then in terms of the laminates, I'm assuming it's LVL type markets, if that's what you folks are asking about. That's both a demand and a supply story. There's not a lot of G1, G2 veneer available to increase supply and to increase output. So as housing starts come back, those markets are going to remain tight, and so we should see upward pressure on LVL prices.
Okay, one last question. Do you think the intermediate threat of tariffs against friendly countries such as Canada will cause a long-lasting damage to our reputation as a trusted partner?
I hope the answer to that is no. And I am going to say that I trust our Canadian partners that have been, that we've been partnered with. I'm from Boston, so I mean, in the Northeast, we are, I guess we're probably closer to a lot of the Canadians than other regions of the country. I mean, obviously, spatially we are. I think that generally the Canadians, I think that there won't be permanent damage. I think that there could be a period of distrust that lasts longer than 4 years. But I think that we will be able to mend this relationship with Canada. I think that in terms of Mexico, certainly there's an issue with fentanyl coming across the border. There's an issue with illegal immigrants coming across the border. That's something that does need to be worked on. That's not really, in my opinion, it's not an issue. And I haven't seen any data that indicates it's an issue with Canada. If we're talking about Europe, Europe does have a bunch of tariffs on US goods that we don't have on their goods. So we probably do need to come up with a new trade agreement with Europe that is a little bit more equally balanced to the US. So I think that that's something that if we're taking it apart from Canada and Mexico, I think that's something that folks in Europe will eventually understand, and we can get to a new level of a new trade type environment that has more equal restrictions on both sides. And like I said, with Canada, I do think that this is an attempt to renegotiate the USMCA, and I think that we'll have a renegotiation of that. And then I think that we will, it won't be, I don't think we'll be seeing long-term permanent damage.
Okay, thanks, Paul. I'm just going to take over the screen one more time. Okay, so just as a reminder for CEU credits, please email chris.lawton@farmcrediteast.com for any attendance requirements there. And then I just want to thank Paul one more time. We had a lot of great questions and a lot of good information shared. And once again, this recording and Paul's presentation materials will be available online at farmcrediteast.com. Thanks for joining us today and have a great day.
Thank you. Thanks everyone for listening, and I appreciate it. Have a great day.